Due diligence is like a home inspection before you buy a house. In an M&A deal, the buyer checks many rooms of the target firm. The core components are financial, the most heavily weighted, approximately 50 to 60% of valuation, because cash flow drives price. Commercial/market, about 15 to 20% confirms growth assumptions and market position. Operational, 10 to 15% looks at processes, supply chain, IT, and the cost of combining the two businesses. Legal, 5 to 10% ensures contracts, IP, and litigation risk are clean. Tax, 5 to 10% evaluates hidden tax liabilities or assets that can swing the effective purchase price. Each component feeds into the valuation model. The relative weight reflects how much uncertainty it can add or remove from the price. Analogy: think of building a puzzle. Each piece, financial, legal, etc., must fit. If the financial piece is missing, you cannot see the picture. If the legal piece is flawed, the puzzle may fall apart after you finish. Cash flow adjustments remove non-recurring items, one-off litigation settlements, furniture purchases, etc., and add back recurring but not cash expenses, depreciation. The adjusted free cash flow (FCF) is computed as FCF adjusted equals EBIT1 minus tax rate plus depreciation and amortization minus CapEx minus change in working capital minus non-recurring cash outflows. Pro forma EBITDA. This is the EBITDA after normalizing for add-backs. Formula: EBITDA a pro forma equals EBITDA, a reported plus add-backs, restructuring costs minus excluded items, discontinued operations. Valuation sensitivity analysis: the buyer builds a simple discounted cash flow model and then varies key assumptions: growth rate G, discount rate R, EBITDA margin M. Example: enterprise value equals sum from T1 to N of FCF, adjusted T divided by 1 plus R to the T plus terminal value. Terminal value equals FCF, adjusted N times 1 plus G divided by R minus G. By changing G from 2% to 4% or R from 8% to 10%, the analyst shows how the valuation swings, highlighting which assumptions are most risky. This helps the buyer decide how much premium to pay for the target. Legal due diligence is the title search of the deal. It looks at three main risk buckets. Contractual risks: review all material contracts, customer, supplier, leases, employment for change of control clauses, termination penalties, or hidden obligations. Example: a key supply contract may allow the supplier to walk away if the buyer changes ownership, which could jeopardize production. Litigation risks: scan lawsuits, arbitration, and regulatory investigations. Assess exposure, potential damages, probability of loss. Analogy: discovering a hidden crack in a house's foundation that could become costly later. Regulatory risks: verify compliance with industry-specific rules, for example FDA for pharma, GDPR for data. Identify required licenses and any pending investigations. A missed permit can force a shutdown, dramatically reducing value. The legal report usually assigns a risk rating: low, medium, high, and recommends clauses to renegotiate or indemnities to protect the buyer. Tax due diligence is the financial plumbing check. It focuses on three pillars: deferred tax assets, DTA/liabilities, DTL. These arise from timing differences between accounting and tax bases. The formula for a DTA is DTA equals tax rate times tax carryforward minus accounting carryforward. A large DTA can boost value, but if the buyer cannot use it, for example, lack of taxable income, it is effectively worthless. Tax structuring implications: decide whether the acquisition is a stock purchase or asset purchase. An asset deal may allow the buyer to step up the tax basis of assets, generating future depreciation deductions, but may trigger higher transfer taxes. Post-deal tax integration: plan how to combine tax attributes, consolidate returns, and manage intercompany pricing. For example, after a merger, the combined entity might be able to offset the target's loss carryforwards against its profits, reducing future tax bills. Analogy: think of a water system. If the pipes are misaligned tax structures, you lose pressure cash later. The tax report often quantifies net tax benefit loss in dollars and provides a risk rating. Operational due diligence examines how the business actually works and how it will fit together with the acquirer. 3 case steps. Synergy quantification, identify cost saving, for example, consolidating overlapping facilities, and revenue enhancing such as cross-selling opportunities. A simple formula for cost synergies. Cost synergy equals sigma overlapping cost I minus post-merger cost I. If both firms have 2 HR departments costing $5 million each, and the merged firm can run one for $6 million, the yearly cost synergy is $4 million. Integration cost estimation, estimate one-time expenses needed to achieve synergies, such as system integration, severance, consulting. Example, a $10 million IT integration project over 2 years. Working capital impact, assess changes in inventory, receivables, and payables. A common metric is the cash conversion cycle CCC. CCC equals days inventory outstanding plus days sales outstanding minus days payables outstanding. If the target CCC is 60 days and the acquirer's is 45 days, the buyer can improve cash flow by 15 days, freeing up cash. Analogy: merging 2 kitchens, you can reuse oven synergy, but you need to buy new dishwashers integration cost and adjust food storage working capital. Commercial due diligence validates the market story behind the deal. It focuses on market size, estimate total addressable market, serviceable available market, and serviceable obtainable market. Example, TAM equals $100 billion, all consumers of product type. SAM equals $30 billion, segment the target can serve. SOM equals $5 billion, realistic share the target could capture. Competitive positioning, map the target on a positioning matrix, price versus quality or market share versus growth. Identify moat sources, brand, patents, network effects. Revenue forecast validation, compare the target's internal projections with external data, industry reports, comparable companies. Use a sanity check ratio such as revenue growth equals industry growth times share of market growth. If the industry is growing 5% but the target claims 20% growth without a new product, the claim is suspect. Analogy: buying a bakery, you need to know how many people in town want bread, market size, how many other bakeries exist, competition, and whether the bakery's sales forecast matches the town's population growth. The due diligence output includes a revised revenue model and a confidence rating, high, medium, or low. Deal breaker triggers are the red flags that can stop or renegotiate a transaction. They are risk-based and usually tied to specific financial or operational metrics. Common triggers is revenue decline. If the target's quarterly revenue falls more than 10% below the agreed baseline, the buyer may walk away. Key customer loss. Loss of a customer that accounts for more than 15% of revenue. Regulatory approval failure. Failure to obtain a required license within a set period. Contingent consideration modeling. When the buyer wants to protect against these uncertainties, they use earn-outs or holdbacks. A simple earn-out formula. Earn-out payment equals sum from T equals 1 to N of metric sub T minus target sub T times multiplier sub T, if metric sub T greater than target sub T. Example, if the target must achieve 10 million EBITDA in year 1, and actual EBITDA is 12 million, with a multiplier of 0.5, the earn-out equals 12 minus 10 times 0.5 equals $1 million. Analogy: think of a sports player's contract that pays extra if they score more than a set number of goals. The extra pay is contingent on performance. The DD report lists each trigger, its measurement method, and the proposed contingent payment structure. Post-deal integration turns the paper deal into real value. 3 pillars are essential. KPI alignment. Define a short-term 0 to 12 months and long-term 1 to 3 year scorecard that blends both companies' metrics. Example: KPIs, combined EBITDA, a margin, customer churn, integration cost burn rate. Ensure each functional leader's bonus is tied to these KPIs to drive focus. Governance structure. Set up an integration management office, IMO, chaired by a senior leader from each side. Create clear decision-making rights, for example, finance decides cost synergy targets, operations decides plant closures. A RACI matrix: responsible, accountable, consulted, informed, clarifies roles. Earn-out mechanics. If the deal included earn-outs, track them with an automated dashboard. Define data sources, verification processes, and dispute resolution steps. Analogy: merging two orchestras, you need a conductor governance to keep everyone playing the same sheet music, KPIs, and a score earn-out that rewards soloists when they hit the right notes. The integration plan typically includes a 100-day action list, a budget, and a risk register. Explanation: typical MBA exam questions test both conceptual understanding and practical application. Below are sample prompts and a scoring rubric. Question 1, case study, 30 points. You are the chief financial officer of a private equity firm evaluating a $500 million acquisition. List the 5 core due diligence components, assign a relative weight percent to each, and explain how a 5% overstatement in earnings before interest, taxes, depreciation, and amortization would affect the valuation. Rubric: 5 points each for correctly naming components, 5 points for reasonable weight allocation, 10 points for impact explanation showing understanding of sensitivity analysis. Full marks require a numeric example, for example, $25 million earnings before interest, taxes, depreciation and amortization overstatement reduces purchase price by $125 million at a 5 times multiple. Question 2, short answer, 20 points. Define a pro forma earnings before interest, taxes, depreciation, and amortization, and illustrate with a simple income statement showing a $2 million one-off legal settlement that should be added back. Rubric: 5 points for definition, 10 points for correct calculation, 5 points for clear presentation. Question 3, multiple choice, 10 points. Which of the following is not typically a deal-breaker trigger? A. Loss of a top 10 customer. B. Slight increase in selling, general, and administrative expense. C. Failure to obtain a regulatory license. D. Material litigation discovered. Rubric: 10 points for correct answer B. Question 4, essay, 40 points. Discuss how you would structure an earn-out for a target with volatile earnings. Include formula, metrics, and governance safeguards. Rubric: 15 points for clear formula, 15 points for justification of metric choice, 10 points for governance discussion, for example third-party auditor, dispute resolution clause. Total points 100. Each answer is graded on completeness, accuracy, use of quantitative examples, and clarity of explanation. High-scoring answers blend theory with a real-world analogy, for example house inspection, sports contract earn-out.